Hello and welcome to the Global View. Lovely to be here with you on this Friday morning, the 19th of June. I'm Nadine Blaney. Well, U.S. stocks finished the week on a strong note, led by a rally in tech shares. The S&P 500 rose more than 1%. The Nasdaq pretty close to 2% as semiconductor stocks surged. That's after U.S. President Donald Trump said Intel will partner with Apple to design and manufacture chips domestically. Intel jumped sharply, helping lift the broader chip sector to fresh record highs. Amongst the top performers, SanDisk climbed close to 11.5%, while Super Microcomputer advanced 11%, reflecting renewed enthusiasm for tech stocks. Elsewhere, SpaceX shares extended its post-IPO pullback, falling a further 3.5%, marking a second consecutive day of losses as investors book profits following the stock's record-breaking debut. Amazon shares rose after reports the company is exploring sales of its custom AI chips to external data center operators. So that's broadening its challenge to NVIDIA's market dominance. And Moderna advanced after FDA advisors endorsed its flu shot, strengthening the outlook for biotech's next wave of growth products. Elsewhere in the sector, Pfizer fell. Its CEO is preparing to step down. Well, Wall Street now heads into a long weekend with U.S. markets closed for Friday's Juneteenth public holiday. Economic data overnight painted a pretty resilient picture of the U.S. economy. Weekly jobless claims fell broadly in line with expectations, while the Philadelphia Fed manufacturing survey improved sharply, driven by stronger new orders and employment. The U.S. dollar extended its post-Fed gains. The Aussie dollar held firm, though, above 70 U.S. cents. Central banks remained firmly on hold. We heard from the Bank of England. It left rates unchanged at 3.75%, signaling that tighter financial conditions are already helping to cool inflation. And with U.S. markets closed for Juneteenth, attention today turns to Japanese inflation data and political developments in the UK. U.S. Treasury yields, by the way, they did edge lower overnight. The 2-year Treasury yield fell 1 basis point. The 10-year yield declined 3.6 basis points. And investors looked past the Fed's hawkish hold. Markets continued to price a 40% chance of Fed rate hikes next meeting. Little changed from immediately following that FOMC meeting under Warsh. Commodity markets were relatively subdued. Oil prices stabilized after sharp declines earlier in the week, helped by easing geopolitical tensions following that U.S.-Iran memorandum of understanding. Gold fell more than 3%, though it does remain higher over the past week. Industrial metals were mixed. Zinc extended gains, now at 4% for the week. Copper and aluminium weakened. So yeah, the stronger U.S. dollar really impacting commodities investors, really balancing improving growth against that strong U.S. dollar. Well, let's get some analysis on that, and we get Rob Thummel joining us from Tortoise Capital. Rob, a very warm welcome to the Global View. Shall we start with energy? So give us your take on the oil price, because if you look post-war, if we can hopefully call it that, compared to pre-war, I mean, it really tells a story.
Well, it sure does. It sure does. As you highlight, and Tortoise, this is what we focus on, is the energy sector. And before the war, the prices was in the U.S. and even globally was around $60, $75 or $60 or $70 a barrel. Obviously, as inventories have been depleted, the Strait of Hormuz has been closed, prices have risen, and at times we've seen oil prices near 100. Now, oil prices have come back down, as you mentioned earlier, and so we would expect that if the Strait of Hormuz is opened back up, and ships are able to move consistently through the Strait of Hormuz, oil inventories will rebuild, and you'll see oil prices come back down. And that probably will be good from an inflation perspective. It'll be good from a driving perspective. Gasoline prices will fall. Other consumer products prices will probably fall. And then we'll leave it at, we'll see what the U.S. Federal Reserve does as a result of that.
Yeah, because we forget here down under sometimes that it's peak driving season, or pretty much so in the U.S. with summer holidays really upon you. So what does that mean for oil companies, for oil and gas companies? because they obviously look to make hay while the sun is shining. But talk to us about how they are expected to perform going forward then.
Yeah, so for U.S. oil and gas companies, they've had a pretty good year in the U.S. stock market. They've been some of the better performers to a certain extent because of the higher oil prices. A lot of U.S. large major oil companies like Exxon and Chevron, their earnings profile, their cash flow profile will track a little closer with commodity prices, with oil prices, with natural gas prices. But there are some pipeline operators in the U.S. that actually have less commodity price sensitivity. That's what we tend to like at Tortoise. We like dividend-paying stocks that pay investors a nice dividend, that grow the dividend, and we see those opportunities more in natural gas actually more than we do in oil.
And so just give me the investment thesis for natural gas over oil. Is it part and parcel of this whole energy transition story?
It's part of it, but it's more so, what's the new world going to be, and what's going to drive the new world. And at Tortoise, we think that actually electricity is the new oil. And what I mean by that is if AI is the future economy, I think we all know now, and we've learned, we're going to need a lot more electricity, and that natural gas actually will be the source of that electricity, both here in the U.S., but also globally as well. And so we think that there's a tremendous amount of supply of natural gas in the U.S., in Canada, in Australia as well. And that low cost commodity and that low cost of supply of commodity actually can help boost the global economy and drive this global AI race that we think will be very competitive. But the U.S. has a huge competitive advantage because of the low cost of natural gas here in the U.S. and its ability to use a lot of low cost natural gas to build a lot of electric generation that will be the primary driver behind the global AI economy that goes forward.
So Rob, just to dig a bit deeper into that, are you more in favor of the producers? Do you see more opportunity in the producers or in some of the infrastructure plays? Because to get that gas to electricity, you need a whole heap of infrastructure.
Yeah, no, that's a great question. Great, and it's a great observation. We like both. I mean, first of all, a company like Expand Energy in the U.S., it's a name that's probably not as familiar with in Australia, but it's one of the largest producers of natural gas in the U.S. And so that company we expect to perform pretty well because we think that the demand for natural gas is going to go up. The price of natural gas in the U.S. is going to go up as well. We also like companies that as you highlight, that like a Williams company that transports the natural gas, right? That's really important as you highlight. You have to have a transportation network, and in the U.S. we operate one of the largest energy infrastructure networks in the world. And if you own those assets, then you're able to transport that natural gas to where it needs to go, and that's a really important component as well. And so we like those companies as well as companies like Cheniere Energy that you might be familiar with in Australia a little bit because of exporting liquefied natural gas. The U.S. is one of the largest exporters of natural gas, like Australia is as well. But Cheniere actually is the largest exporter of liquefied natural gas in the U.S., and we think that there's significant growth opportunities for the U.S. to grow its market share in liquefied natural gas exports really over the next several decades.
Okay, so a bit of competition perhaps for Australia. Where do you see the end market for those exports being?
Yeah, no, that's a great question. So we see those end markets being predominantly Asia, South Korea, China, in some cases India. And so it's natural gas actually, what we're realizing is I think is pretty important from an economic growth perspective. It really helps countries grow their industrial base, and it grows their manufacturing base because of the high intensity fuel nature of natural gas. And so anywhere where there's economies want to grow, they're going to need more natural gas. And so the largest economies in the world, China, India, the U.S. need more natural gas, and the U.S. and Australia and Canada will be providing a lot of that.
Now, just because you brought up the data center thematic as well, we hear about a lot of the pushback about data centers there, a lot of concern over the rising costs of electricity. Do you like any of the utilities, any of the power providers?
Yeah, we think that if electricity is the new oil, and AI is the next industrial revolution. You want to have some exposure to some of the utilities that are providing that electricity. In particular, a company like Vistra Energy here in the U.S. that generates electricity right in the heart of where a lot of this data center activity is. It's in Pennsylvania and Texas to a certain extent, and Vistra Energy is going to generate a lot of electricity in that particular area. Or those areas. And so we expect that Vistra will have a lot of demand for its electricity generation, and the prices probably in those areas also are going to move higher as well because of the scarcity of electricity generation, because of the increase in data centers that we're seeing here in the U.S.
So, Rob, do we have to sort of shift our thinking away from just energy as a commodity story to something much bigger, much more? I mean, commodity is obviously very fundamental, but it's just a different way of thinking about the complex.
Oh, I agree with you. That's a great way to say it, and I think you're exactly right. I think you got to think electricity is the new oil, and I think you got to think energy entirely different. Electricity is going to drive things going forward, whether it's for manufacturing, industrial activity, or electricity generation for the development of AI and the new economy going forward as well.
Economic security, you could say. Rob, look, it's been a pleasure to have you join us this morning, obviously evening for you. Really appreciate it. We hope to have you back.
Thanks for having me.
Rob Thummel from Tortoise Capital. All right, let's just check in on what we are expecting here locally. The market gets up and running in a couple minutes' time. Expecting to see our market go its own way yet again. I had a chat with Scott Phillips from the Motley Fool. He said we used to sort of assume that our market would follow the US market. But while we were sleeping, metaphorically and literally, I suppose, overnight, the US market and its composition has changed so dramatically, and it's so different than what we've got here. Banks and miners as opposed to SpaceX. Just let's do that for shorthand. So yeah, he said that, we're in sort of a new era. And he said you have to pick your stocks very carefully. That's why you watch AusBiz. Hopefully we can help you a little bit with that, or our experts can. Look, stay with us. I'll bring you through the open next.